Hello everyone, my name is Radovan Vojtko, I'm CEO and Head of Research at Quantpedia. So today's video will be about the alternative data. What are alternative data, you may ask? So alternative data are predictors which are not price-based or fundamental-based, like balance sheet, income statement, etc., but are from other sources, and you can use those alternative data to predict prices of equities, fixed income, commodities, crypto, etc. So for crypto, it will be something like on-chain analytics. For equities, it will be something like the tweets of the CEOs, etc. Alternative data sets are usually expensive. There are not a lot of them which are for free, and you will usually need to buy them. We are very happy when we are able to find out the alternative data set which costs nothing and has interesting predictive ability. A few weeks ago we were able to identify one such data set, and I would like to show it to you at the moment. Just a very quick info about how many strategies do we have in our database that are related to alternative data. Over 200. So they are, quite popular. If we have 1,200 strategies in our database at the moment and 200 of them are based on alternative data, you can see that it's quite a popular topic.
Unlock the power of Quantpedia Pro with over 900 premium strategies extracted from 100,000 research papers and more than 30 quant reports. Model full portfolios, generate real-time reports and save hours of work. Quantpedia Pro, your edge in quantitative investing.
What is the dataset? So it's a producer price index for corrugated and solid fiber box manufacturing industry, including corrugated boxes and pellets. It sounds awful. So what does it mean? It's a dataset that tracks the prices of paper boxes, and those paper boxes are used, of course, for online trade. So if you buy something from Amazon, it will come to you in a paper box. So the price of the paper boxes are very good predictor of business activity, online shopping activity, etc. So the rising production or consumption of packaged materials signals higher demand for these inputs. So the companies produce or purchase more paper boxes and pallets when they need to ship a larger volume of goods, and increased packaging demand therefore serves as a proxy for growing order flows, stronger consumer activity and higher throughput across supply chains. This is what we can get out of that. And what is the added value is that this dataset is available for free on a monthly basis, and you can download it from Fred. So it's absolutely great dataset. Okay, so we downloaded dataset. Here is how it looks like. Here is the link. It's in our article, and then we try to use that dataset. So what is it useful for? So we can try to predict the price of the Amazon. The Amazon is one of the biggest companies in the world, and the main bulk of the business of the Amazon is based on shipping the goods and taking the goods, packaging the goods in the paper boxes and sending it to you. So the price of the paper boxes should predict the performance of the Amazon, because if the Amazon needs more boxes, it will buy more of them and you will see it in the price. And if Amazon needs more boxes, the price of the Amazon should go high, because they will have a lot of the money, a lot of the cash and a lot of the sales. What other can we predict? We can predict the difference in performance between the consumer discretionary stocks, so those are the cyclical stocks, and consumer staples, healthcare and utility stocks, which are defensive stocks. So we can predict the business activity, and we can try to switch between the companies that are sensitive to business activity, and in case there is a jump in activity, and we can move to the defensive stocks in case there is some recession or something like that. So how to do that? So firstly, we tried some different statistical models, but they were not very successful because there are some problems with the homoscedasticity and heteroscedasticity of dataset. If you are more interested, feel free to read our explanation. But then we moved to moving average models, which are not sensitive to heteroscedasticity. We had very great success with those moving average models. We tested the end-man moving average of the underlying producer price index for paper boxes, and we try to use that as a timing signal. So then we have the SPY model as a naive benchmark. So why you would spend the time of using some alternative dataset if you can just buy a SPI? So the SPI performance and the risk rating ratios are our benchmark, and we will try to beat these benchmarks of passive buy and hold of US equities by using this predictor. So firstly, we try to time individual SPI. Using this dataset, it didn't make a lot of the sense for prediction of the SPI. The SPI consists of a lot of the other sectors. There are a lot of the defensive sectors, the IT sector, there are technology stocks, etc. They are not very sensitive to the price of the paper boxes. So it doesn't make sense to predict the whole market. You really need to focus on the specific sector or specific industry. So then we moved to switch models for sector ETFs. It was significantly better. So what is the idea? Firstly, we tried to XLI, XLP strategy. The idea was to buy the cyclical sector when the producer price index is over the moving average of its own price, otherwise switch into the defensive sectors, so the consumer staples, when the producer price index is below the moving average. So the rising price of the boxes should signal you to buy cyclical stocks, and when the price of the boxes goes down, you should switch to defensive sectors. Okay, we tried different moving averages from 3 to 46 months, and here are the results. If we took just the cyclical or defensive stocks and then we take our switching model, we will realize that we have a better performance, lower maximum drawdown, better Sharpe ratio, better gamma ratio. So I mean, it really makes sense to use this alternative data set to switch between defensive and cyclical stocks. But we can improve with that. We can upgrade our defensive part of the portfolio, so not just use the consumer staples, but we can add utilities and healthcare, and we can improve the performance even better, and I mean Sharpe ratio even better. If we move from the cyclical stocks into the portfolio that consists of 3 ETFs equally weighted, the healthcare, utilities and consumer staples, I mean we can improve the performance even better. We have a lower volatility, we have a better performance, lower maximum drawdown, better Sharpe ratio, better gamma ratio. So it's really interesting alternative data set. What is the best period to use? I do not like to pick just one period, let's say 12-month moving average, and based on my decision 12-month moving average. I like to diversify among multiple models. What I would probably do is that I would run like 4 models, 3-month moving average, 6, 9, 12-month moving average, and I would switch between the defensive and cyclical stocks or cyclical ETFs based on all 4 time periods. So I would split portfolio into 4 parts, and I will use 3, 6, 9, 12-month moving average, and each quarter of the portfolio will be run by a different model. That's what I will do, and here is the resultant equity curve for 3 to 12 and 3 to 46 month models. What you will get diversification. The whole portfolio will be more stable, which means better performance, lower drawdown, better Sharpe ratio, better gamma ratio, etc. And last question, does this approach work for individual stocks as well? Yeah, it works. We turned our attention to Amazon. In case of the Amazon, we did not try to switch between the Amazon and defensive portfolio. We tried to switch between the Amazon and the cash. We have a performance of the Amazon, which is an extraordinary 20% performance, but with a higher risk, 40% volatility, 86% drawdown. So we do not have the very great Sharpe ratio. But if we try to time the Amazon stock and try to be in the stock when the price of the boxes goes up and be out of the Amazon when the price of the boxes goes down or it's under the moving average, and instead buy the bill, so short-term treasury ETF, we may have a little lower performance, but we have significantly lower drawdown, lower volatility, so our Sharpe ratio, gamma ratio is significantly better. If we combine those models together, here we have the combined model, we have like 17% performance, 18% volatility, so Sharpe ratio nearly 1 and gamma ratio 0.7. Significantly better results on the risk return basis than just holding the Amazon stock. Of course, you can have a better performance just holding the Amazon stock, but with a significantly high risk. So there is a really big difference between minus 25% drawdown and minus 85% drawdown, which you would have if you hold the Amazon ETF over the last 20 years. So I hope that you like this article. I hope that you like the dataset that I showed you. It's a really interesting dataset. You cannot use it for everything, but if you would like to use it for some specific sector or specific stocks, it's a great predictor and you can obtain it for free from Fred. So great dataset, very simple model. I hope that you like this methodology. In case it is so, please give us like, subscribe to our channel, visit Quantpedia, and if you are interested into more alternative dataset strategies, we have over 200 of them in our database. So feel free to subscribe to our database, and there are hundreds of ideas that you can use directly in your trading. Thank you very much, and I hope that you will join me in the next video.
Are you interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.